This is a continuation of the cash flow statement video. Last time I remind you that we were trying to work out what part of this net profit here involves cash. Now, as I said to you, you've got to add back depreciation and interest, and that will give us the profit before changes in working capital. Now, all credit transactions, all year-end adjustments like income accrued, expenses accrued, consumable stores on hand, etc., appear in either inventories, your debtors, receivables, or your payables, which are your creditors. So what we're going to do now is we're going to look and see how those have changed, and by doing that we can determine whether cash is coming into the company or going out. If you look at inventories I think are quite straightforward. If stock increases, it means you've bought stock. And obviously when you buy something, you pay for it, so that is going to represent an outflow of cash. If stock decreases from year to year, that means you've sold more stock, and if you sell stock, you will receive money, so that will be an inflow of cash. Moving on to your receivables. With your receivables, if receivables decrease, it means your debtors have paid you back. If your debtors pay back, you're going to receive money from them, so that will be an inflow of cash. If, on the other hand, receivables increase, it means you've basically allowed more credit. Now, if you look at an example here, in your income statement, you would record next to sales in your answer column, in your income statement, your total sales figure. If, however, some of that was on credit, in other words, some of the sales were for credit sales, then you need to eliminate that effect when calculating your actual profit that is in the form of cash. So if total sales are 50,000, 10,000 of these sales are credit sales, then only 40,000 should be included when you're calculating your net profit, or cash portion of your net profit. So if your receivables increase here, it's going to mean that less of this net profit here is in the form of cash. So that figure will be put in brackets. It's not an outflow of cash, you're not paying anything, but it reduces the amount of profit that is actually in the form of cash. If we move on to our payables now, if payables decrease, that's simple, means you've paid back your creditors. If you pay something, that's going to represent an outflow of cash. If payables increase, on the other hand, means we've been allowed to buy more on credit. That means we haven't had to spend so much cash. So for example, if stationery was purchased was 12,000, that would appear in your answer column of your income statement when calculating net profit. But if 4,000 Rand of this was purchased on credit, then only 8,000 should have actually been deducted when you calculate net income. So in other words, if payables increase, more of this here, this profit here is in the form of cash. So if payables decrease, simple, you're paying back. If payables increase, you bought more on credit. If you buy more on credit, you spend less cash money. So therefore you're going to add those credit purchases back to get to this figure here, and final answer, which is going to be the cash part of your net profit. Right, moving on now to dividends. When we're looking at dividends, we're trying to work out the dividends that we've actually paid. Now the first thing you have to pay is any dividend that you owed from last year. Remember, at the end of the year, dividends are declared, not paid. So you're going to look at the shareholders for dividends to see how much you owe the shareholders for last year. Because you're going to pay that amount this year, that will be an outflow of cash. If you go to your retained income note in the balance sheet, you have an amount for dividends there, which is actually your total dividend for this year. In other words, it's your interim plus final dividend, and that represents what we should have paid. So you've put that figure in brackets. But at the end of the year, you won't have paid that final dividend yet, because that will also only have been declared. So you look at your shareholders for dividends, and that will not yet have been paid, so therefore it's a positive figure. If you look at this in summary then, The dividends that we actually pay are last year's final dividend, that's this one, plus this year's interim dividend, which is a difference between your retained income amount for dividends and your shareholders for dividends at the end of the year. And remember, dividends are being paid, so that will be an outflow of cash here. In terms of taxation, we also need to work out the amount of tax that we've actually paid. When you're dealing with this, it depends where SARS is in your balance sheet. If it's got a credit balance or if it's got a debit balance, it's going to be treated with differently. So let's look at this first column here. If SARS had a credit balance at the end of last year, it means you owe money to them and you're going to pay them this year, so that is an outflow of cash. In your income statement, the tax amount that you record is your expense for the year. In other words, the amount that you should have paid. If at the end of the year SARS has a credit balance, it means you've actually paid less tax than you were supposed to. So that figure will be in brackets. Not in brackets, rather. If you look at SARS when they have a debit balance, if at the beginning of the year SARS has a debit balance, it means they owe you. So that figure will therefore be a positive figure because you don't have to pay it. The amount in the income statement is the amount that you should have paid for this year. If at the end of the year SARS has a debit balance, it means you've paid what you should have paid and you've paid extra. So that debit balance will also be in brackets. So in summary then, the amount of tax that you actually paid will be any amount owing from last year, that's this one, plus this year's provisional tax payments, which is the difference between what you should have paid and what you still owe, or if it's a debit balance, it's the total of what you should have paid plus the extra amount that you've paid. Right, let's move on now to investing activities, which are your fixed assets bought or sold, as well as your fixed deposits which have been increased or decreased. If fixed assets have been purchased, you obviously pay for those, so that will be an outflow of cash, and you will report the cost price of the asset bought. If fixed assets have been sold, that's going to represent an inflow of cash because you're going to receive money, and the amount that you use is going to be the selling price of the asset sold. And at school level, we assume that we always sell fixed assets at carrying value. Then in terms of your fixed deposits, if fixed deposits increase, it means you've taken money from your bank and invested it elsewhere, so that's an outflow. If investments decrease, then it means your fixed deposit matures, you're getting that money back, so that will be an inflow of cash. Right, and then lastly, your financing activities. If loans are increased, it means the bank's giving you money. You're borrowing more money from the bank, so that will be an inflow of cash. If loans are decreased, it means you are paying back, so that will be an outflow of cash. If you sell shares, you receive money for those shares, so that will be an inflow of cash. And if you buy back shares, that's going to be a payment. You pay the existing shareholder to buy back their shares, so that will be an outflow of cash. Now what I've got here in this table is a summary of calculations for cash flow statement. I want to stress this first one here, fixed assets bought or sold. In the cash flow statement, I'm talking about either fixed assets purchased here or proceeds for disposal of fixed assets. It is essential that you show your workings in brackets here, because if you don't, and you get your answer wrong, you're going to throw away a lot of method marks. So you must show your workings here if you are buying and here if you are selling. So basically what we do is the following. We start with the carrying value at the beginning of the year. Anything that you buy will increase your assets. Anything that you sell will decrease your assets, and depreciation takes down the value of your assets. And that will give you your carrying value at the end. And then whichever one here you're trying to work out, you simply make X and solve for it. But there you must show these workings. At least 1, 2, 3, 4, 5 plus a method mark, 6 marks for this calculation. You cannot afford to throw 6 marks away for not showing workings. If you make an error with one amount, you will still get 5 out of 6. Then loans. This here is if the loan increases as well as decreases during the year. So you start with your loan at the beginning of the year, you add any new loan, and you minus any loan repaid, and that must give you your loan at the end of the year, and whichever of these two you're trying to calculate, you make X. As I mentioned earlier, the tax that you pay is any tax owed from last year plus this year's provisional tax payments. And I also mentioned this as well. Your dividends are going to be last year's final dividend and this year's interim dividend. One other amount that I didn't go through is the amount of interest paid. I'm talking about this interest paid here in the cash flow statement. Now, if interest is owing, which incidentally is highly unlikely because the bank doesn't allow you to owe them interest, they just take it. However, you still need to be able to deal with this if they give you an expense accrued amount for interest. So the amount that we're actually going to pay this year is any interest we owed from last year, any expense accrued for last year, as well as the interest we paid this year. Now in your income statement, matching was followed, remember, so you recorded the interest that you should have paid. But if you owe some of that, means you haven't paid everything that you should have paid. So you're going to take the interest that you should have paid and subtract what you still owe. All these workings need to be shown in brackets here, especially if you're not required to do the notes to the cash flow statement. One last thing that I want to stress here with cash flow statement, and that is when we are doing cash flow statement, matching does not apply like it did for income statement. In your income statement, you recorded income and expenses that you should have paid for the current year. With your cash flow statement, you're going to record amounts that have actually been paid, even if that should have been paid last year or you are paying in advance for the following year. So in terms of deciding what to record, work out what was actually paid or received during the year, and that will be the amount that is recorded. Thanks.